You think you know this company because you have their app on your phone. You don't. You are looking at the user interface of a global logistics empire while we are looking at the source code. This isn't a store. It is a deflationary weapon system disguised as a website. This is a GreenCandle forensic audit. While the news talks about Prime Day, we are tracking the thermal signatures of their data centers. We are stripping down Amazon, ticker symbol AMZN. Put down the package and look at the blueprint. We aren't here for free shipping. We are here for triple-digit returns. The market is currently valuing Amazon at $2.48 trillion. That sounds like a lot until you realize they are pricing it as a retailer with a hobby. That is a categorization error. It's like valuing a nuclear submarine based on the price of the screen doors. They are missing the margin supercycle. The thesis is simple. We aren't buying a digital Walmart. We are acquiring three separate monopolies, AWS, ads, and robotics, that are all hitting a deflationary tipping point at the exact same time. This is an efficiency singularity. Here is the math that breaks the bearish narrative. AWS is the only cloud giant decoupling from the Nvidia tax, with margins over 40%. Ads is a $70 billion pure profit printer, and robotics has achieved peak labor, meaning volume is going up, but human headcount is going down. When you stack these distinct monopolies, the $2.48 trillion valuation looks like a clearance sale. We are establishing a price target of $330, a 42% upside. That implies a real value of $3.5 trillion. The calculator doesn't lie. The market is just bad at math. The street assumes AWS is trapped in the same room as Microsoft and Google, just renting Nvidia chips and capping margins at 30%. That is empirically false. Look at the forensic data. As of Q3 2025, AWS has migrated 50% of its internal workload to its own custom silicon. They moved Bedrock, Alexa, and their ads optimization onto their own hardware. They aren't renting the shovel during the gold rush. They built their own forge and melted down the competition. That is sovereign infrastructure. Let's talk about the Nvidia tax. Look at that cost per token metric. While Microsoft pays market rate for H100s at roughly $0.004 per token, Amazon's internal Trainium 2 cost is $0.002. That is a 50% to structural cost advantage. This is the difference between renting a Ferrari and owning the factory that builds them. While competitors pay 65% gross margins to run AI, AWS is paying itself. This project's operating margins breaking 42% in 2026. Efficiency is the ultimate alpha. Shift gears to the warehouses. Amazon has crossed the robotic event horizon. They have deployed over 1 million mobile units like Proteus. The data point that matters is touch points. It used to take 7 humans to ship a box. Now, it takes 3. Every time a robot touches a package, the variable cost drops. The algorithm is ruthless. For every 10% increase in robotic penetration, variable labor cost drops by 4%. They are engineering the human error out of the P&L statement. This is the Henry Ford moment for logistics. Amazon has converted inflationary variable labor, people who need raises and sleep, into deflationary fixed capital. Robots don't unionize, and they don't take coffee breaks. The result? North American retail margins are about to shatter the historic ceiling, hitting 8.2% in Q4. Wall Street still thinks this is a low-margin grind. They haven't noticed that the warehouse is now just hardware, running software. Now, look at the silent engine, advertising. It is generating $70 billion at 60% margins. Those $45 billion in profits are doing something incredible. They are covering 100% of the global retail CapEx. Do you understand what that means? The retail business is effectively free. It is self-funding. This leaves the massive cash flow from AWS completely unencumbered to be returned to shareholders. It is a perpetual motion money machine. The hidden asset is supply chain as a service, or SCAAS. The arbitrage is almost unfair. Amazon's robotic cost per package is under $4.80. FedEx and UPS are sitting at over $9. That is a structural 50% gap. If Amazon captures just 10% of the independent shipping market, that is $25 billion in high-margin revenue. They aren't just delivering their own stuff anymore. They are becoming the utility company for physical goods. Circle February 5th, 2026. This isn't just Q4 earnings. It is the moment the rule of 100 kicks the door down. We predict annualized operating income blasts past $100 billion. The street is stuck at $90 billion, likely because they are still modeling this company, like it's a bookstore from 1998. Why is our model $15 billion higher? Because we accounted for the unholy trifecta: Trainium cost cuts, robotic efficiency, and the absolute mountain of cash from political ad spend. The market is staring at the rearview mirror, while Amazon is reinventing the engine. The surprise is baked into the silicon. Look, I read spreadsheets, not crystal balls. If the global economy drives off a cliff, Amazon is in the passenger seat. But barring the apocalypse or a sudden desire for bankruptcy, the physics work. The structure holds. The sum of the parts valuation is so lopsided, it looks like a typo. AWS alone is worth $2 trillion. When you toss in ads and retail, you get nearly $4 trillion. It's like buying a house for the price of the driveway and finding out the mansion is included for free. Even if we grade on a curve and stick to a conservative $3.5 trillion, the discrepancy is wild. The current share price isn't just lagging reality, it is buffering on 1990s dial-up. So, how do we play the architecture? The action is an aggressive buy in the entry zone of $228 to $235. The ripcord is set at a close below $210. And the thesis break. Watch AWS margins. If they drop below 35%, the Trainium story is fake, and they are just renting chips like everyone else. That is your canary in the coal mine. We don't trust, we verify. Look at the satellite imagery of the Ohio data centers. See those cooling towers? They are designed specifically for Trainium clusters, not standard GPUs. The thermal signature is different. That heat map confirms the massive deployment of custom silicon is real. The hardware proves the software thesis. The revolution is being televised. You just have to look at the infrared. Amazon is in a sovereign state of efficiency, converting human cost into silicon assets. They aren't trying to beat inflation. They are engineering it out of existence. Amazon has stopped being a retailer. They are a sovereign state of efficiency, converting human cost into silicon assets. They aren't trying to beat inflation. They are engineering it out of existence. We just showed you the blueprints. The narrative is expensive, but the math is free. Trade the reality. GreenCandle out.